What's going on, guys? Travis Yo here. Yo Money Matters because yo money matters. And welcome to part 2 of Can I Even Retire? Again, this is a term that's been searched on Google for the past 10, 15, 20 years because people today don't even think they can retire. And if you see my latest videos, we went over what's your financial independency number. We went over different saving methods, how you can get to your retirement, and then we went over the different types of retirement accounts that are out there. So if you haven't seen those videos, go ahead and check them out. But today we're gonna be going a little bit more in detail. I'm gonna simplify it. I'm gonna call this episode Retirement 101. So let's jump in. All right, so as I'm posting these videos, I was reminded that not everyone understands retirement. So with these fancy terminology that's been throwing out here, IRA, Roth IRA, 401k, qualified, taxes, a lot of people don't know what these mean. So I was reminded as I was talking to a client who asked me a question, and again, it doesn't matter how old you are, people need to understand this information. And that's why I do this channel, and that's why I want to give you guys value. If you have any questions, feel free to post on the comment section below, send me a DM on Instagram so that I can get your answers or your questions answered. Now we're gonna be breaking down again how retirement works. Now, as I mentioned in the previous videos, there are 2 phases when it comes to your retirement. There's the accumulation phase and the distribution phase. Accumulation phase again means that this is the time where you're putting money into these retirement plans, you're growing it over your lifetime, and then the distribution is when you start taking out the money. Now, there are actually 2 different kinds of money that you put into these retirement plans. The first one is called qualified money, and the other one is called non-qualified money. And all that really means, guys, is it taxable now or is it taxable later? So let's dive into how these work. So let's go over the pros and cons of qualified money. Now, before I can do that though, we have to understand how qualified money works. Now, as an employee, we typically make a paycheck, correct? Now, we typically have our gross money or our net money. What's the difference? Gross is actually what you earned, either as an hourly wage or your salary pay. Net is actually what you get to keep and take home. Because gross, you have to have all your deductions in between. Your federal, your state taxes, your Social Security, Medicaid, Medicare, all that stuff need to be taken out of your check before they give you the net dollars, and that's what you get to now deposit into your bank. So when it comes to qualified money, they're gonna be using the gross money in your paycheck. So this money has not been taxed yet. So the best pro when it comes to qualified money is that you're not paying taxes today. You actually get to defer them to when you retire, and you can now take out the money. Now, when it comes to qualified money, there's only really 3 main retirement account vehicles that use qualified money. There's 401k, there's a 403b, and also a traditional IRA. Another pro when it comes to qualified money is that actually you can use those as a taxable write-off when you do your taxes. One of the last pros that you have with a qualified account, especially if you're in a 401k or a 403b, the maximum amount you can contribute into these plans in 2023 is $22,500. Or if you're over the age of 50, you can do what's called a catch-up contribution, where you're able to actually put an additional $7,500 more, bringing you to a total of $30,000. Now, if your company does match, the maximum that they can match you is actually total amount of what you're contributed plus what they match, $66,000. So when it comes to the cons of qualified plans, you gotta understand taxes. Yeah, your money is being tax deferred, meaning you're not paying any taxes on the gains that you receive, but you guys have to understand that taxes today, historically, are at an all-time low. From 1982 to 1986, the highest tax bracket was 50%. From 1965 to 1981, the highest tax bracket was 70%. And then this is gonna blow your mind. From 1946 to 1963, the top tax bracket was 91%. Now, obviously that's after World War II, and they're going through tax reform and all that fun stuff when it comes to tax laws and IRS. But what's the tax rate today, guys? The highest tax rate in 2023, 37%. So, would you rather pay taxes today at, let's say, 37%? Or would you want to pay possibly 2 to 3 times in the future when you're ready for retirement? The second con when it comes to qualified accounts is actually you do have limitations on when you can withdraw the money. So in every single 401k, 403b traditional IRA, you cannot touch the money until you are 59 and a half years old when it comes to making withdrawals. If you do take out a withdrawal, you have to pay an additional 10% tax penalty. Also, you will also be penalized if you leave your money too long in this type of account. Once you hit the age of 72, you need to take what's called required minimum distribution. Because if you don't start taking that, Uncle Sam will actually penalize you an additional 50% on your minimum distribution. Not the entire amount, but the minimum distribution. Now, for non-qualified plans, you have things like your Roth IRA or LIRP or L.A.S.E.R funds, or your basic bank things like money market accounts and CDs. So when it comes to non-qualified money, going back to our gross versus net, this is actually going to be the net dollars because you have already paid the taxes on this money. So you're going to use this specifically in a Roth IRA or a Roth 401k. When you put the money into these plans, it's actually going to grow tax advantaged, meaning when you start taking the money out for retirement, you're not paying any taxes on the interest. Now let's go over the pros and cons of traditional IRAs and Roth IRAs. And the difference is actually a lot of different changes. It's not just qualified versus non-qualified money. In either a traditional or a Roth IRA, you do have what's called contribution limits. That's the most money you can put into these types of retirement plans per year. And both have a $6,500 per year limit. Or if you're over the age of 50, you can do a $7,500 catch-up contribution. They're both still tied to the same 59.5-year rule. Meaning if you take withdrawals before the 59-year mark, you're still going to get taxed an additional tax penalty. Now, when it comes to Roth IRAs, not only do you have the 59.5 rule, but you also must wait 5 years until you can start taking out your money as well. So if you started your Roth right at 50 years old, it's probably not going to be the best bet if you want to start taking out your money in a year or two. Another con when it comes to a Roth IRA is that if you actually make too much money, you do not qualify for a Roth IRA. Meaning, in 2023, if you are considered married and you're filing your taxes married, if you both make more than $228,000 part of your adjusted gross income, you do not qualify to use a Roth IRA. If you are single, if you make more than $153,000 in that year for your adjusted gross income, you do not qualify to use a Roth either. As we talked before, a traditional IRA, you do have what's called the required minimum distribution that you have to take at the age of 72. In a Roth IRA, there is no required minimum distribution. If you guys have any questions at all when it comes to retirement, go ahead and post it down in the comment section below. I'd be more than happy to get those into my part 3 and my part 4 of this video. Or if you're someone that's really considering retirement and you really want an expert's opinion, go to my website at yomoneymatters.com. It's right there in the description below, and actually schedule a time with me where you can actually sit down one-on-one, we can talk about it. And that pretty much wraps up for today, guys. My main question to everyone watching is, where are you holding your money? What type of retirement account do you have? Is it qualified? Is it non-qualified? So your homework is to go look at all of those to make sure, are you having the best type of retirement for you, for your goals, for your financial goals? Because there's a saying that actually by a guy named Miguel de Cervantes, who wrote the book Don Quixote, which actually has coined the term, never put all of your eggs in one basket. I live by this. Diversify your portfolio And guys, if you liked the video, go ahead and click on that like button. And if you haven't already, click on subscribe. Stay up to date for all the video drops. I have part 3 and part 4 of Can I Even Retire? Coming right up. Stay tuned.